Welcome to Pimpy's Investment Chat, where we keep investment talk simple. And here's your host, Pimpy.
What is going on out there, peeps? All right, let's talk about the Vietnam Dong. I got a group of people ask me what's the latest and the greatest. There's some movement happening over there in Vietnam. If you remember the last time we spoke about the Vietnam Dong, it had lost value against the US dollar. Of course, on the claims that the US dollar is getting stronger and stronger. Every time Jerome Powell hikes interest rates, the emerging currencies around the world lose traction against the US dollar because the dollar is getting stronger. Before we get started, hit that thumbs up button, and if you're not a subscriber, please do so, because when you do, it helps out the channel, and I certainly do appreciate it. If you're thinking about buying gold and silver, go to our friends over there at Money Metals Exchange. The link is down below in the description. If you're a first-time buyer and you spend more than $100, use promo code Pimpy, P-I-M-P-Y, and you will get a free half ounce of silver. So there is some movement happening over there in Vietnam that is pertaining to their currency. It says Vietnam interest rate rise. Benign SBV may be forced to act if inflation rises, Dong plummets. After leaving interest rates unchanged from 2020, the State Bank of Vietnam surprised the market with a jumbo hike of 100 basis points to shore up its currency, the Vietnam Dong. That's a 1% hike. That's pretty big. The Vietnam interest rate rise on September 22nd was SBV's first response to the U.S. Federal Reserve's aggressive hikes, which have seen the U.S. dollar strengthen against emerging countries' currencies. And some of those currencies are definitely crashing. Yesterday I explained in the video that we just watched Lebanon's economy crash, and now India's economy is crashing. See the domino effect? And we got Europe now. Yes, Britain. They're getting ready to crash, and when they go, all hell breaks loose. With analysts projecting the Fed to continue monetary tightening until next year, will the Vietnam interest rate be able to catch up and close the rate differential? We examined its history and factors driving the bank's policies in 2022 and beyond. We don't need to know the history of the bank. We'll get past all that stuff and get to the good stuff. Under the 2010 State Bank of Vietnam law, the SBV carries out monetary and banking activities, foreign exchange management, issues money, and provides monetary services for the government and other public services. SBV operations aim at stabilizing the value of the Dong, ensuring safe banking operations, as well as ensuring the safety of the national payment system. Within its monetary policy, the SBV aims to maintain an inflation target of 4%. But unlike other central banks in developed countries, like the Fed, the SBV is not an independent body. It operates under government supervision. The Prime Minister and the SBV decide on monetary policy tools after the National Assembly. The country's parliament sets an annual inflation target based on the government's proposal. The bank's main policy rates are the refinancing rate for short-term loans, the discounted rate, and the interbank lending rates. So there's the interest rate history on SBV. SBV increased its refinancing rate to an all-time high of 15% in June of 2008 to combat soaring inflation, rapid credit growth, higher public spending, and surging food and energy prices pushed the inflation rate to the peak of more than 28%. Ouch. August 2008 data from the International Monetary Fund showed the central bank lifted the refinancing rate to 15% again in October of 2011 before gradually lowering the policy rate. By December 2018, the Vietnamese interest rate stood at 6.25%. Can you imagine having to deal with an inflation rate of 28%? That's a 28% loss in purchasing power. In 2019, the SBV had only one rate cut, lowering the refinancing rate to 6%. With the benign inflation, SBV kept its refinancing rate unchanged at 6% until the RONA emerged. In 2020, the Vietnamese central bank had 3 rate cuts, lowering the refinancing rate to a record low of 4%. So what is driving the latest Vietnam interest rate rise? In the latest Vietnam economic news, the country's central bank made its first interest rate hike in 2 years. SBV lifted the refinancing interest rate by 100 points to 5%, while the discount rate was increased to 3.5%, the central bank announced on September 26. What were the factors driving the central bank's decision? Let's investigate the key factors that were likely to shape the policy. And I know some people, what's this got to do with the exchange rate, Pimpy? It has everything to do with the exchange rate. Rising inflationary pressures. Although inflation rate had averaged 2.58 in the first 8 months of 2022, well below the 4% target. That's really good. So if their target is 4% and they're sitting at 2.58 inflation, yeah, that's obviously where we need to get to. SBV expressed concerns about persistently high inflation abroad and the second round of raising inflationary pressures at home. So the country's consumer price index continued to ease in August, falling to 2.89% from 3.37% June peak. The statistics office said that the fall in petroleum prices compensated for the increase in price of consumer goods and services and education tuition. The DBS economist wrote in a note on September 23rd. Further upside pressures will still be present due to the ongoing domestic strength, even as external demand landscape becomes more challenging. Policymakers would be keen to curb such upside pressures, especially to avoid higher inflation seen in previous episodes. So what they're talking about right here is when they say external demand landscape becomes more challenging, as countries tighten up their monetary policies and raise interest rates, that means less and less people are spending their money. They become tight with their own money and they save. So there's not a lot of spending going on, therefore the demand for goods lowers. On September 28th, ANZ Research forecasted the inflation rate in Vietnam to average 3.4% in 2022. The firm said, that's not bad. Right now, this administration is lying to us and trying to get us to believe that our inflation rate is only at, a little over 8.5%? No, it's double that. It says, however, from Q4, there are risks that headline CPI inflation will remain elevated for a couple of quarters and will require further monetary policy responses. So everything that we do here in the United States obviously affects the rest of the world. So as the Fed continue to raise interest rates, trying to cover up their asses and all the debt that they have, it gives the impression that the US dollar is gaining strength, which affects the exchange rate with the US dollar and other countries' currencies. In September, the Asian Development Bank kept its Vietnam inflation rate forecast unchanged from April's estimated 3.8% for 2022 and 4% for 2023. Yeah, that's still really nice. So here we go, weakening dong. I know the first thing that popped in your head was probably the same thing as me. Viagra. Tang suggested the main driver of the central bank's policy rate hike may be weakness in the Vietnam dong against the US dollar, although the currency has outperformed its Southeast Asian peers, noting in a meeting in September 26, the Prime Minister asked the SBV to regulate with different monetary tools such as the exchange rate, interest rate, credit limits, and 2% interest rate subsidy program. Right here it says, in our view, the policy rate hike's trigger was likely the Vietnamese dong weakness versus the US dollar, coupled with expectation of further US dollar upside pressure following the upward shift in the Fed's expected terminal interest rates. The VND's depreciation to an all-time low does not provide comfort to policymakers in the rising inflation environment. Yeah, but what goes up must come down. Eventually, the dollar is going to collapse in a big way. Is it possible that Powell is taking the Volcker approach? So it says the exchange rate for the US dollar to Vietnamese dong rose 0.13% on September 28th to an all-time high of Vietnamese dong, which is 23,760 for every one US dollar, according to the data from Trading Economics. As of September 28th, the currency pair had gained 4.43% year to date. So the US dollar has gained 4.43% on the Vietnam dong in this year so far. Which is interesting because I guess it was about 3 or 4 months ago the Vietnam dong was getting stronger and stronger against the US dollar, and its value kept rising against the US dollar. Now all of a sudden it's going in a total opposite direction. Compared to other Asian currencies, the dong has performed relatively well. Yeah. I'm going to leave that right there. So right here, they're going to give examples of other currencies. This is what I'm talking about. The US dollar is crashing currencies around the world right now. So the Japanese yen has sharply depreciated, with the US dollar gaining 29.23% on the Japanese yen. The Filipino peso, the US dollar has gained 15.87% over the Filipino peso. The Indonesian rupiah, the US dollar has gained 6.79%. These are not little gains, they're pretty big. ASEAN Research forecasts that the US to Vietnam dong to average 23,800 Vietnam dong for every 1 US dollar for this year, dropping to 23,500 in 2023 and 23,250 in 2024. So as you can clearly see, there's no forecasted rate hike in the Vietnam dong as far as 2024 is what it looks like, unless something drastic happens, and I'm anticipating the downfall of the US dollar. Right here it says, although the recent hikes in the domestic policy rate will help Vietnam dong, the US Fed's rate hikes are expected to far outstrip the SBV's hikes by the end of their respectively hiking cycles. Furthermore, the ability of the SBV to defend the currency has diminished due to the rapid drawdown in its foreign exchange currencies reserves. So you probably heard me talk about Iraq and how the fact they have, $87 billion now in foreign reserves. That's good, and it protects their currency. You can see here what's happened in Vietnam. They're depleting their foreign currency reserves just to try to protect the value of the Vietnam dong. This is why you need to build up reserves. So it says Vietnam's interest rate outlook for 2022 and beyond. The dong is facing increasingly downward pressure from the Fed's policy tightening, and the inflation rate is expected to accelerate. So what's the outlook for another Vietnam interest rate rise? DBS Vietnam's interest rate forecast expected the SBV to normalize the refinancing rate to the pre-RONA levels of 6% by the fourth quarter of 2022 and to potentially reach 6.5% by the first quarter of 2023. You can see right here it says key factors that will drive additional policy rate increases include curbing downside currency pressures in the context of rising inflation and less need for a very aggressive and loose monetary policy stance given the robust post-pandemic recovery. He stressed that the low interest rate policy, which worked for extraordinary conditions during the pandemic, was no longer justified, particularly with the risk of recession in the United States, Vietnam's largest export destination. So all countries are anticipating a huge recession, which we're actually in now, but it's going to get worse. Which means then what? The citizens of the United States will be tightening their belts, they'll be saving their money, and there'll be less spending. So there's no need for us to import from other countries, which affects their economies. Right here in this block, it says a careful monetary policy normalization to rebuild some buffers would instead place Vietnam in a better position to deal with an increasingly difficult global external environment. Long before the RONA came out, long before then, I was already talking about how all the economies around the world are going to crash. It just drives me crazy to see all these different articles claiming that it was the pandemic that caused this. No, it wasn't. So there you have it. Right now, Vietnam's trying to do everything it can to protect its currency. It's losing traction against the US dollar, but so is a lot of other currencies. I said it before and I'll say it again. It appears that they're using the US dollar to crush currencies around the world. And once that's done, then ours is right behind it. So I guess the best way to put it is like this. Let's say you're going to fight a good opponent in the ring, and you're boxing, right? So if you have a way before the fight starts to beat your opponent down, weaken them, hurt them, injure them, so they're not as strong against you when you're in the ring, then you do it. That's what the US dollar is doing. It knows it's going to crash. So what it's doing is killing all the other currencies ahead of time. You know what I mean? Severely injuring them so that when the US dollar's down and the other currencies start to go up, they won't have such a huge head start, and the US can quickly recover and get back up with the other currencies, if not get ahead of them again. So what you do is you just beat your opponent up and make sure that they're so hurt that when it's time for you to crash, you're almost level with them, is what's going on. Anyways, that's it for now, you guys. You guys let me know what you think. I look forward to what you have to say, and I will catch you later. I'm out.